So many people don't know about these tax advantages and haven't taken advantage of any of the benefits.
The wells that we're drilling right now, right outside of Midland, Texas, we're drilling 10, 11,000 foot laterals and finding between 1 million and 1.5 million barrels of oil. And those will produce out over the next 40 years.
The idea of putting $100,000 into something that one doesn't understand is really concerning.
I think it's just a great time right now to be investing in oil and gas. Last year we hit 103 million barrels of oil consumption, which was the highest in history. Losing your money, I think that is off the table. You aren't going to lose your money.
Welcome to the Executive Connect podcast. Today, we're going to talk about tax strategies in oil and gas and timeless things you can use this year in 2025. Welcome Don Hosmer, co-founder of Royal Energy, with a deep expertise in oil and gas exploration for investor benefits. I'm so excited to have you here today, Don. Thank you for joining us.
Hi, Melissa. Good. Thank you for having me here today.
Don, I want to just kick it off with talking about some of the tax advantages that people need to know about in oil and gas.
Sure. So really, it started back in 1986 when a lot of the partnerships were setting up and buying working interests and wrapping them into the limited partnerships. And that would offset some of the high taxes. Back then, it was about a 50% top tax bracket. And so everybody was buying oil and gas partnerships in order to offset that high ordinary income tax. Well, when Reagan came in, he passed what was called the Tax Reform Act of 1986, and he brought down those high 50% tax rates. But in turn, he eliminated the deductions from those passive investments, limited partnerships. But they specifically exempted the working interest form of ownership in oil and gas drilling from the passive loss rules. And so you can deduct your entire drilling investment from your ordinary income, capital gains, any kind of taxable event can be directly offset with an investment in the drilling operations.
I love it. Let's talk a little bit about how you got into this space, Don. Can you share with our listeners how you found the oil and gas industry?
Sure. I was in college still, my senior year of college, and my father, who was a real estate developer his whole life, kind of semi-retired and began investing in oil and gas with the former governor of Oklahoma. And he set up a package of 4 wells. And they went to start drilling them, and the financing fell through at the last minute. And so I went and found most of the money on that project, and the investors got 100% write-off, 50% tax bracket. They got half their money back the first year, and then the rest of it they were getting $5,000 a month, so another $50,000-$60,000 first year of income. And so they got a tremendous investment on those 4 wells. And so that was so much fun and such a good investment. I've been doing it ever since for the last 35 years.
You know, what's interesting to me about the oil and gas space is so many people don't know about these tax advantages and haven't taken advantage of any of the benefits. So I want to kind of get your opinion on why this is. Why do more people not invest in oil and gas outside of buying stocks? Is there a reason? Is it the SEC rules? Is there anything specific you can share with our listeners?
Well, oil and gas is a high-risk enterprise, and there's no doubt about that. There's risk in geology, there's risk in pricing, and so there's just a lot of different risks. But the tax deductions were put in the tax code back in 1913 when they were hitting maybe 1 out of 20 wells. It was wildcatting. And the government doesn't invest in oil and gas. Our U.S. government, unlike most countries where the government owns the oil and gas reserves, our country relies on the private sector. And so these deductions were put in the tax code in order to direct capital into oil and gas drilling and develop our energy resources. And so that, was back when it was very high risk. Now, with the advent of 3D seismic and drilling with horizontal and fracking through a continuous accumulation of oil, so it's been much lower risk now. In fact, our current project, they drilled over 120 wells in the field and no dry holes. And so where you used to hit 1 out of 20, now we're hitting 10 out of 10, and we're getting the same tax deduction. But I think a lot of people just still, equate oil and gas as a risky investment, which it does still have risk, but a lot less risk now with the advent of modern fracking and drilling into a continuous accumulation of oil.
Yeah, when I think of oil and gas, I think of some of the cartoons I've watched as a kid. Drill, soda straw, no oil, move over, drill, soda straw, no oil. But now, like you were saying, with fracking, you drill once and frack, and it's likely that you're going to hit oil. So the benefits substantially increase with fracking versus just drilling. I want to talk a little bit about breaking down what IDCs are and why they are such a game changer for investors. As a technologist, I think of fracking like I think about technology in a way that it just increases. There's a substantial increase in benefits to using fracking. So by using it and able to drill more holes, how does that help investors with what they're going to get back from these deals?
Well, you've seen all the mergers. Exxon bought Pioneer for $60 million. Oxy bought Crown Rock for $12 billion. Conoco bought Marathon. They're all buying in the Permian right now. And the reason is really multi-stage fracking. It's been a game changer. In the old days, they would frack across the entire 10,000-foot interval, and the pressure would dissipate, and you wouldn't get as deep of penetration into the rock. Well, now we go every 200 feet, set an iron bridge plug, and frack into that 200 feet oil rock. And so you get higher rates, higher oil reserves. We'll put as many as 60 fracks on a 10,000-foot interval. And so it's been a game changer. All the majors, they treat it like manufacturing. They know the oil's there. They know what their costs are to drill for it. Just what is the variable price of oil going to be? And so it's really been a game changer out there. Reduce the risk, increase the economics. And then when you include that tax benefit, which is still in the tax code, you're literally paying for your oil reserves with your taxes through your tax deduction of the investment.
Are you a high-income professional looking for smarter ways to protect your wealth? The Texas Freedom Fund gives you the opportunity to invest in energy assets leveraging proven fracking technology and prime access to global markets. With strategic oil and gas investments, you can build real wealth while benefiting from tax advantages under laws dating back to the Reagan era. Take control of your financial future. Visit texasfreedomfund.executiveconnectpodcast.com.
Yeah, I think of it like also, I'm trying to think of how to ask this. It's like mailbox money, right? I think of some of the benefits of getting money every month, like I do a rental home, right? Somebody pays you their monthly rent. You take your money off that monthly rent. Is that the same analogy with these IDCs? Are you paid monthly? And then kind of the second question is, the real risk sounds like the cost of oil to me, outside of any other risk that there may be. So I guess that's a two-part question. Part one, is it something that people are getting paid monthly? And then kind of part two, is the risk just really the cost of oil?
Yes, so you're correct. All the oil is sold, each month, and then distributions are made at the end of every month. And we used to call it mailbox money. Now we ACH it directly into their bank account for the most part. So that's directly deposited into the investor's account at the end of it every month for the prior month's production, and for both the sale of oil and natural gas. Now on the tax deduction, that's taken right up front. That intangible drilling cost deduction can be taken immediately the day that you invest. So if you're making estimated quarterlies, that can offset that estimated quarterly payment. If you are at the end of the year, planning to sell a property or a business or have high ordinary income, that's going to directly offset that and reduce your adjusted gross income. So in some cases, it can actually bring you into a lower tax bracket, but in every case, it'll give you back whatever your top tax rate is. So if you're in a 30% tax bracket, you'll get 30% back right away. Whatever state you're in, you'll get that state amount back. And then on the income, that monthly income, 15% of that is going to be non-taxable through the depletion allowance. It's actually a cost recovery. In the old days, they would take the total oil reserves and then divide it out, and you'd recover it over the life of the reserves. Nowadays, they just do a straight 15% is non-taxable, and that's a additional cost recovery for your investment.
So is that how that plays out for the entire time of the drill? So that 15% of the gross income, that's for the whole long-term
life
benefit?
Of the well.
Life of the well.
It is. Yep.
So
you're literally paying for your reserves through your tax write-offs.
That's amazing. Now, how long do the wells usually can you pull from? How long is the life of the wells?
So that's going to vary depending on how many reserves you find in the well. The wells that we're drilling right now, right outside of Midland, Texas, we're drilling 11,000 foot laterals and finding between 1 million and 1.5 million barrels of oil. And those will produce out over the next 40 years. Those will have a 40-year life.
Wow, that's amazing. I want to kind of circle back a little bit about people that are new to this. So just kind of summing what you said, people could invest, they have to be accredited investors, right, to invest in these drills. And what is an accredited investor in the oil and gas space?
Yeah, so they're sold in a private placement memorandum, Regulation D. And so that just requires that an investor either has $200,000 a year of income or $1 million net worth of assets. If they have either one of those, they're deemed to be accredited and can invest in the projects.
Now, what if they're a married couple? Does that change the $200,000?
Yes, for married couples, it's $300,000.
Okay, and then
the million stays the same for married couple. $1 million net worth.
Okay, fantastic. I want to talk a little bit about how, when I think about these IDCs, accredited investing, like you were saying a little bit, they're more of a riskier investment. So a lot of times, women are less risk adverse and men are more comfortable with risk. So in your opinion, if people are investors of stocks and IRAs and rental and crypto and all these ways to invest, what % of people's portfolio do you think IDCs could be for an investor now that have high ordinary tax income?
Well, it really depends on what your investment goals are. If you're looking for, tax deduction, how much tax deduction do you need? If you're looking for income, a lot of our investors are selling a business and retiring. Probably 30% of our clients are retiring and taking money out of their IRA or 401k, which creates a taxable event. So they'll take $100,000 out of their retirement account and put $100,000 in the drilling, and it completely offsets that taxable event and then creates a monthly income for their retirement. So it really just depends on what your specific investment, goals are.
Yeah, that makes sense. That's a tough question. I'm curious, as our new president has some very specific goals. I keep replaying in my head, drill, baby, drill. I know that's something that's been, he talks a lot about. So are there any tax policy changes or proposals this year that could positively affect oil and gas, and maybe something that investors should consider with our current president?
So the last time President Trump was in office, he passed the Tax Cuts and Jobs Act of 2017, where he enhanced the tangible wellhead equipment. We used to depreciate it over 5 years, and he put in what's called bonus depreciation, full expensing. Now that's reduced now down to 40% bonus depreciation, but he also enhanced the Section 179, which allows you up to $1 million of expensing of property or equipment. And so unless you're depreciating over $1 million, you can take the full expensing the first year through the 179 election. But as far as what he's proposing now, we haven't seen anything, in terms of what he might or might not do with taxation on oil and gas.
Yeah, and I know that you have to have a large amount of cash up front to invest in some of these deals. Some of these oil and gas deals are hundreds of thousands of dollars to invest. So it's capital intensive. So we're recording this in March of 2025. Is there anything that would draw investors in right now when they're trying to decide, do I put $100,000 into the stock market versus oil and gas versus all the other investments one could invest in? Is there something that we could talk about that would interest people to put their money more in oil and gas now versus some of these other investments within the stock market?
Well, with oil, of course, you've got a hard asset that is stored in the ground and produced out for monthly income. And so if you're concerned, about the stock market collapsing or maybe a bank failure or something, you've got a hard asset stored in the ground. You've literally owned oil barrels and natural gas in the ground. And so that is produced out, will always be produced out. People will always use it for, heating their homes, electricity, transportation. So we'll always have a market for the oil. We import, 50% of our oil right now as a nation. So we'll always have a market to sell that into. So you've got cash flow and I think safety of holding your asset in the ground.
Yeah, Royal Energy focuses mostly on domestic production. And I know living in Austin, sustainability and renewables are really trending. Where do you see oil and gas fitting in today's energy mix?
Sure. So we're seeing a great deal of demand increase for electricity, AI and all the electronics components that are being used now. And so energy overall is increasing pretty dramatically right now. Oil and gas is 80% of that demand. And so you're going to have demand growth. In fact, the International Energy Agency says that we'll probably have 2% per year for the next 5 years. And last year we had 103 million barrels of oil consumption, which was the highest in history. And so we could well be over 110 million barrels per day of consumption within 5 or 10 years. So we think there's strong demand for it. And, it's just a good time to own oil and gas right now.
Yeah, it sounds like it. Now, I want to circle back to maybe one thing for people that have never heard about oil and gas. I know if you've not heard about IDCs and investing in some of these drills, the idea of putting $100,000 into something that one doesn't understand is really concerning. So is there one thing that we could point people to or boil it down for them to give them confidence that oil and gas is a safe place to invest right now, no matter what year it is, even if gas is a little bit lower next year than it is this year?
Yeah, so we think it's a good time right now because of in our case, the advent of multi-stage fracking. We're in a 20,000 acre play right outside of Midland, Texas. Exxon has drilled several wells to our north. They just went and bought another 3,000 acres to the south. Occidental Petroleum is drilling right on our eastern edge. And Continental, 4 of the largest producers in Texas, are drilling right around our acreage. In fact, we've received 2 written offers from 2 of the major producers out there. So this is an area where the risk is low. We haven't had any dry holes. They're all high rate, between 800 and 1,300 barrels of oil per day. and long life reserves. As I mentioned earlier, these will produce for 40 years. So this is just a unique opportunity. In my 35 years in the business, I've never been 100%. We always have a dry hole here or there. In this play, because of the continuous accumulation of oil in that shale, we have not hit any dry holes. So,
that's amazing. Now, how does Oklahoma and Texas compare to other parts around the United States? Is it have more oil or less, or how would you say they compare?
Well, first of all, they're much more friendly to oil. We were a California producer primarily, and here in California, it's become much more difficult to do business in the oil and gas arena. So Oklahoma and Texas, certainly more friendly. And as in the case of the Permian Basin, that's got 12 different layers of oil. And most of those have been penetrated and drilled vertically with vertical wells. But now with this modern multi-stage fracking, we're going back into shale formations that were not economic previously. And so it's just opened up a whole new area. The majority of undrilled wells is right there in the Permian Basin.
That's great. Now, as we any final thoughts or predictions you want to share with our listeners on oil and gas as we continue to head through 2025?
Well, I think the current administration is going to make it much more friendly and less regulatory. It'll lower our overall costs of doing business. It'll open up more areas, certainly. Federal leases were off limits under the previous administration, so federal leases will become more active in drilling. And so I think the whole environment is going to be just much better. I think we'll have more demand for oil and gas going forward, less regulation on using it. And so I think it's just a great time right now at this early stage of the new environment to be investing in oil and gas.
I love it. I know we talked a little bit about this before. I know a lot of times oil and gas, from the tax standpoint, CPAs don't really understand how to navigate IDCs or how to take these write-offs because it's not a popular thing. Is there any advice you can give to our listeners who are presenting oil and gas investments to their CPAs and the CPAs are telling them this is a bad investment or a risky investment or I don't know anything about it? Is there any advice that you could share with those listeners?
Well, a lot of CPAs think they're talking about a partnership. And right away when they say oil and gas, they think partnership, which is not deductible against ordinary income. But if we give them our tax book, we have a tax book we can send out to anybody electronically or hard copy, but that will identify the tax code and show them exactly where that's a legitimate write-off. And so it's a standard Schedule C business deduction. You're deemed to be in the oil and gas business when you own a working interest in an oil and gas well. So to that extent, you write it off on your Schedule C. And then that comes around to the front page and reduces your adjusted gross income by the amount that you put in. Back in 2021, I had a guy, Mike Weaver, out of Tucson, Arizona, call me and he said, I received a stimulus check in the mail. And he said, I called my CPA and I said, how in the world did I get a $1,200 stimulus check? And his CPA told him your royal investment reduced your adjusted gross income below $75,000. And that's what generated the check. And so it's a great way not only to recover your drilling costs through the tax refund, but it also reduces your overall tax bracket in some cases.
That's great. I love that you guys have that book to share with our listeners. Don, anything, I know we covered a lot quick, rapid fire. Is there anything you want to leave with our listeners or any final closing thoughts?
Well, I think if you've, not been in oil and gas because of the risks, there certainly is still risk. I don't want to let anybody know there's not, but a lot of those risks are mitigated now by using 3D seismic, which we have on all of our drill sites, and then good well control, and then using modern multi-stage fracking. I think when you mitigate the risk in those three ways, you've reduced your risk quite a bit. You can't reduce the risk of prices. You can't reduce the risk of pressure or different production risks. But overall, I think losing your money, I think that is off the table. You aren't going to lose your money. You're going to get your tax write-off and get monthly income. So.
And that's what we all love, monthly income and decreasing our tax burdens. So thank you so much, Don, for being here today and sharing with our listeners all about IDC, oil and gas investing. I know you're a busy man. That is the Executive Connect podcast. Please follow us, subscribe, and let us know what you'd like to hear.